Welcome to the Risk Reversal Podcast. I am Dan Nathan. That is Guy Adami. It's Monday morning, shortly after the opening. Good morning, Guy Adami.
Good morning to you. It is a glorious morning after a glorious weekend.
It was that. You, Friday afternoon, you were, betting on the ponies? You're up there, as you call it, at the spa up there?
The spa, that's Saratoga.
Yeah.
I believe the track was constructed in 1847 or something like that. I might be off by a couple of years, but you get my drift. It's like going back in time.
Yeah, this was a destination of like the Rockefellers and the like, those sorts of folks, and now the Adamis grace them with their presence up there. Lot going on Friday afternoon. We had a bit of a sell-off. There's a whole host of things that were going on. Obviously, the jobs report, some of the surprise tariffs announcement, not pushing them out. We had, towards the end of the day, this was kind of exciting, Guy. The president fired the person in charge of tabulating all the economic data as it relates to the jobs thing. That was kind of interesting. I mean, we can go into that a little bit, maybe. I don't think you and I have so much more insight. I think at the end of the day, it really just kind of throws in a level of uncertainty in and around a lot of this data. And then right before the close, Guy, the president, I think he truthed this, that they are sending some nuclear submarines pointed towards Russia. Okay, so that was something a little exciting. But, we had the first down 1% day in the S&P, maybe since like early May or late April. So the market finally started to pay attention a little bit to the potential that we have a protracted trade war. And I think that's something that we should all get comfortable with, Guy.
I think that's right. So in terms of that tweet or whatever it's called now, I'm not exactly certain, but these Ohio-class submarines go out for months at a time. So it's, they've been out there. I mean, that's part of what they do. So I'm not really sure what the intended consequence of that. And that was in response to, I think, a tweet or a statement from somebody out of Russia, number one. So, okay, fine. That's just sort of theater. The BLS thing, to me, is somewhat interesting. And again, I think there's a concern with this administration that you can't have these types of revisions and the system must be flawed. And if the system is flawed, somebody's got to pay the consequences. And, it always starts from the top down. Okay, that's fine. Here's my question to you and to the audience, and something that I think is unanswerable. But if those revisions had been upward, in other words, if they went up by 250,000 jobs, would we be having the same conversation? And my instincts suggest we are not. So just sort of throw that out there.
Yeah, no doubt. I mean, listen, I think that there's on both sides of this thing. I mean, you can look at it as political, and that's clearly how I think the president kind of laid it out there, is that this was somebody who was appointed by the prior president who is looking to kind of conspire against the administration. I think we could all agree that that's probably not the likely scenario, but it is what it is, and it causes a level of credibility to be questioned going forward on this sort of data. But it is, we're just going to have to deal with that. This week, Guy, we have a bunch of earnings. We have a bunch of data. There's obviously a bunch of expected progress on trade deals. I saw something this morning about Canada. Maybe the president is meeting with Carney sometime soon. Again, I think we should expect frameworks. I think that's probably what we've kind of become conditioned to. There's lots of political folks who just want to call them trade deals, but I think we learned from the 2018 sort of tariff trade situation that frameworks rule the day. And maybe that's the sort of thing we just kind of heard as the market kept on plugging higher, Guy, last week until the end of the week, that, the worst case scenarios are out the window. Yet there's still lots of countries and lots of industries that have 25% tariffs on, which is 10x that of what we had, let's say, 6 months ago.
Well, I think that's the point you've been making. I think, let's just say across the board, if we were to round it, we're talking about 2.5%, 3%. Obviously, that 150% that we heard back in April was not going to happen. I don't think that was ever viable, and I think the market sniffed that out. But, even with these ratcheted back, you're still talking about somewhere on the lines of 7x to 10x of what we've basically been experiencing for the last however many years. And I don't think, this is just me, I don't think the market is positioned for or anticipating what the consequences of these tariffs are. And again, we hear from industry after industry, company after company, talking about either they're going to eat it or they're going to pass it on. And in neither circumstances, in my opinion, is that market positive. And you hear the rhetoric around, billions and billions of dollars being taken into our coffers. I'm not exactly sure how that works. I'm not an economist, but what I'll tell you is somebody's paying for this.
Yeah, no doubt. I mean, obviously, it's the importers and their ability and the pricing power that they have to pass it on to consumers. We've already heard from, let's say, Procter & Gamble last week, obviously a huge consumer staple here, that I think they, for all intents and purposes, like, people need our stuff, and we're not going to eat all of those sort of price increases. We'll pull it through. The other thing that I find interesting about this guy is that, the tariff situation, it is what it is. It was fairly well telegraphed. The tax cuts, fairly well telegraphed, right? So the very corporations that are getting an extension, or in many instances, more tax cuts, right, because of this bill, are also the ones that are going to start to raise prices on consumers, right, a little longer that these tariffs are in place. And I think that creates a really difficult situation. It has the potential to slow consumer growth, right? And we know that's a big part of the economy. And so when you think about slowing growth and then higher, let's say, just, costs in general, you have a situation that could lead to a stagflationary environment, which leads me to Mike Wilson at Morgan Stanley is out with a note this morning, Guy. And I just kind of want to paraphrase something here, or just kind of take out what I thought was most important. We think tariff-related inflation will be temporary. Their economists agree. And tariffs could even be disinflation, demand destructive in certain industries, i.e. consumer, where pricing power is elusive. As a result, we think the Fed will eventually transition to cuts. However, a delay of those cuts in the face of weaker growth data could lead to correction in equity markets. Okay, so the last part, we totally get it. The first part about disinflationary demand destruction, Tom Lee, I think in April, was on our podcast of Fundstrat, and he made that same point. Now, I'm not sure I buy it yet. I think the Fed is still kind of obviously staying put, despite what we saw in the revisions and the jobs data, late last week. But do you expect disinflationary? It's one thing to demand destructive. Another is disinflationary.
Yeah, and then these terms sort of get, I think, confused or conflated. I don't know the answer to that, but it was interesting when Tom Lee said it, and that sort of fell under the category of the solution, the remedy for higher prices are higher prices, and if prices get too high, it creates demand destruction. If you see demand destruction, that becomes either deflationary or disinflationary, depending on the interpretation of either word. Again, I don't know how the whole thing plays out. I think in the short term, both can be true. In the short term, it can be very inflationary, and then it leads to some period of disinflation. And I think that's what the market is struggling with. What I'll tell you, though, is if you look at the last couple readings, it is clear inflation is still a bit of a problem, and it's manifesting itself in a lot of different ways, in my opinion. And it's clear that things are sort of slowing down as well. And say what you want, but this is something that Danny Moses talked about it, Doug Cass writes about it, we've discussed it. I mean, there is a potential for this basically screwflation or stagflation or whatever you want to call it environment that, again, at 6,300 and change, the S&P is not prepared for.
4.21, that's where the 10-year U.S. Treasury yield is, okay? So if you think that the Fed has remained somewhat hawkish, right, in an effort to kind of keep inflation at bay, now all of a sudden they have this worry about the labor market, which almost exactly a year ago, Guy, they were worried about the labor market. They were preparing for a 50 basis point cut. And I think what's going to be really difficult year over year, especially as we get into this Jackson Hole situation here where Fed Chair Powell is going to be out there. There's obviously not a meeting here in August. We have to wait until September 18th. We've already saw what the CME Fed Funds futures have done as far as September. They've gone, basically to a near certainty of a 25 basis point cut. I think that was maybe near 50-50 just, I want to say a week ago or something like that. Maybe it was 60-40 or something like that. So the expectations are that the cuts are coming. Now a lot of folks are saying they're going to be too late, right? And again, none of us know that. We're going to have a CPI, we're going to have a PPI, we're going to have a PCE, we might have two, we're going to have another jobs number. So it'll be interesting to see what the next jobs print looks like as you see the BLS in shambles. I don't think you and I can figure that one out on our own. Let's just, so 4.21 in the 10-year, Guy, the dollar, which had this big move from 98 to 100 in the Dixie over the course of a week, that's come in a bit. What's your take right here on what yields mean for equity markets, because this is like what you're kind of throw into all the time. Careful what you wish for, right? If yields are coming down.
Rates are going, this is my opinion, rates are going lower or have been going lower over the last week or so because the data's been getting weaker, and that sort of crescendoed on Friday with this jobs number. And people look at this and say, wait a second, maybe things are not as stable or not as strong as the headlines suggest in terms of the job market. And I think that's why the bond market rallied the way it did. And obviously in the back of that, rates come off. So if that's why rates are going lower, I don't think that's particularly bullish. Although, today at least you see a bit of a relief rally this morning. Maybe that's the interpretation. But slowing data and, things that are deteriorating historically have not been particularly bullish. Now, I think what the market is saying is the Fed will come to the rescue like they always did. They're late to the game, all these different things. We're going to have new Fed governors. Jerome Powell's going to acquiesce. But I don't necessarily think this is about interest rates at this point as much as it is about valuations and a slowing environment. And I think the market sort of came to that realization a little bit on Friday. We'll see how it plays out over the next couple of weeks.
All right, guys, as we get into some of the earnings this week, I think it's important to kind of take a look back last week. And when you think about the move that we saw to the upside, Microsoft and Meta, it was driven obviously by their cloud businesses. I know that there's some folks who are picking at the fact that, Microsoft still doesn't break out a lot of their supposed AI revenue, right, from what's going on in their cloud business. But it didn't really matter. Those stocks raged. And what I thought was interesting on the flip side of that is Amazon did not demonstrate the sort of growth that say that Azure did and Meta did, and the stock was down 8.5% on Friday after its results. The stock is unchanged here on a day where the S&P is up 1% and the NASDAQ is up 1.5%. Respectively, they closed 1.5% lower and 2.25% lower on Friday. So when you think about just the mood and how it might have changed after the Amazon number, and then who is the incremental buyer of Microsoft and Meta, you'd say to yourself, well, outside of those two big beats and raises and the stock's reaction, there really hasn't been that much. Okay, you could say Reddit on Friday was up 16, 17%. It's up another 6% or so today. That seemed pretty specific to that company. They did ink a few cloud deals. They did have much better than expected revenues. The user numbers are better. So I think this is a very specific story within what we used to call social media, guy. But there is this kind of lever that they're pulling as it relates to licensing their data to OpenAI and some of these other big LLMs. So when you think about just kind of the cloud trade, the AI trade, and then everything else that we've seen in tech and then in many other industries, it seems like it wasn't a great earnings season if you're thinking about breadth as far as like what's the leadership going to be going forward if the S&P is going to continue to march towards that 7,000, which a lot of strategists think it's going to for the balance of the year.
Some of the reactions have been head scratching for sure. I mean, the initial knee-jerk reactions on both Facebook and Microsoft were, I don't want to say quizzical or concerning, but you can clearly make an argument that that was sort of the crescendo in terms of especially what we saw in Microsoft. That gap open higher on was big volume. And now, maybe it's coming back to some semblance of normalcy. Facebook, to a certain extent, the same thing. I think what we learned in Google, at least what I learned, I think probably you knew it at the time, was in the aftermath of Microsoft and the aftermath of Facebook, maybe that Google report wasn't as good as I initially thought. And I think Google sort of being stuck in the mud here at 193 suggests exactly that. And Reddit, hard to say. I mean, Reddit had a huge move from, I think, February of this year when it made an all-time high of 230, traded down to, I think, $90. And then subsequently came right back, and here we are. So we've seen round trips like this before. We see it in names like Palantir, which, by the way, reports this week. So that doesn't surprise me, although the moves are astonishing. I mean, again, Reddit is a $35 billion company, so these are not small companies that are doing it. But I take away from earnings so far, and we're sort of, I guess, as they say, stems and seeds portion of earnings. You like that? Of earnings period or earnings season. That, I think on the surface, better than expected. I think the price action, though, is something we're going to come back to and say maybe that was sort of the crescendo for a lot of these names.
Yeah, as you would say, for those home gamers, seeds and stems, that's really what you get at the bottom of a bag. Some people just call it shake. We'll leave it at that. Google
Shake?
it, kids. Yeah, it's called the shake. Listen, this is what I hear. I don't know much. But you did mention Palantir reports after the close, 12% implied move. I mean, this is a stock that obviously continues to perform well. It's up 110% on the year. We've highlighted the fact it trades at 90 times sales. Those sales are probably growing. I think coming into the year, expectations were for 25% growth. They've accelerated a bit over the first half of the year, 31% or so. I'd say expectations are high. I was looking at the options market guy, the skew, and we talked about this a lot in NVIDIA in 23 and 24. You kept on seeing greater demand for calls than you did upside calls than you did downside puts. And the skew was very much to the calls. And that would make you feel like, holy shit, there's a lot of enthusiasm, expectations, excitement, whatever you want to call it, euphoria around buying the upside, right, and playing it that way. With Palantir, the skew is just even. So the out of the money call, let's say 10%, out of the money put 10%, and you're thinking about it in the implied move range, they're even. So that is interesting to me. I do think I was talking to somebody who I think is a very smart technology trader, investor. And, he's saying that what he took away from some of the reports last week was that the upside for AI is there, right? And so here's going to be a great litmus test because about 50% of Palantirs, and probably growing, are associated with AI. And again, that's for a company that basically makes software and is, in the space that they are, whether it be enterprise and then government, it's going to be an easy argument to make that their revenues are AI, but a lot of them are sort of legacy. So at this valuation, if you see some sort of deceleration, in my opinion, in the revenue growth, you're going to have a problem here with a name like this. And, again, you could say, well, it's up 110%. If it goes down 15%, who cares? There's going to be a quarter very soon where the stock's down 25%.
Well, think about what happened earlier this year. The stock made an all-time high, I think about 125 or so in, February-ish, and by April, like many other things, the stock, I don't think it was cut in half necessarily, but it was damn close to being cut in half. And now here we are. You have that basically move from, I don't know, let's call it 70 or so to current levels. I think it made an all-time high today of 160. Personally, I don't think the setup is great going into earnings. I think a lot of people would probably echo that. There are other people that say this thing's just getting started. I know Jim Cramer's been very positive on the name. Good for him. But just in terms of price to sales, now you're talking about a company that's approaching $380 billion of market cap, which is extraordinary, sitting on top of that revenue base. You have to see astronomical growth, historic growth, to rationalize this type of valuation.
Yeah, well, it's trading at 96 times sales. Expectations for EPS growth of 42% this year on 36% sales growth. That decells to about 29% next year, trades at 75 times those sales. Another thing, and we've highlighted this over the last kind of couple weeks, especially into this Figma IPO, is that some of the IPOs this year, we had CoreWeave, we had Circle, these became meme stocks. And both of these stocks now, while they're still up a whole heck of a lot from the price in which they IPO'd, they both are down about 45%. You could say, well, okay, they're still up a lot. So you would have thought CoreWeave would have acted better last week, right, with those CapEx numbers and the like. And so it had a tough week, especially on the Friday sort of, sell-off here. Circle is an interesting guy because there seems to be an awful lot of excitement in and around stable coins, in and around a lot of this regulation. So that stock has gotten creamed a little bit. It's down again today. The one standout for me, though, was Coinbase. This is a company that kind of missed on expectations on revenues. This is a company that gets 75% of their revenue from retail, right? And I just thought that that's interesting, especially when you have Bitcoin only down about 4.5% from those recent highs. MicroStrategy down around 20%. So it'll be interesting to see if we see a disconnect from, some of this retail trading revenue and some of this kind of, treasury sort of strategy. And the last thing I'll just say is that Robinhood Robinhood reported last week, they get only 16, 17% of their revenue from crypto. They get about 26 or 27% from options. Robinhood, which is a partner of ours, full disclosure, we're users of the platform and the like, they have a lot more diversity in their revenue stream, let's say, obviously, than a Coinbase. So to me, I think the fact that Coinbase got creamed like that after its results and after they were disappointing, where on the flip side of that, Robinhood put up a beat and it felt like a raise as far as their commentary with more diversification of revenues. I think that's an interesting one to tease out.
Yeah, I agree. Just in Coinbase, again, just the math, this stock tripled-ish from the April low. And I think that's actually spot on in terms of the math. And again, talking about an $80 billion company now, which is down from the all-time high, I think in July, middle of the month, of about $445, currently trading either side of 320. I mean, the moves are, again, in a word, extraordinary. I don't think, and this is, again, just my opinion, I don't think a healthy market, you see the moves of this magnitude in names of this side. Now, if you're playing a little stock market, maybe we stop here in terms of Coinbase. We're trading down to levels that were resistance for a period of time in February. But, you just don't like to see this type of price action when things basically go straight up in a line and straight down in a line. And the straight down portion is what we've experienced over the last couple of trading sessions in Coinbase.
Yeah, no doubt. Let's rip through a few names that we can maybe extrapolate some stuff to that are not that stock specific that are going to report this week. Obviously, Palantir, we just kind of mentioned tonight after the close, 12% implied move. To me, expectations are obviously very high. And if there was any sort of bugaboos in that one, it'll be interesting to see if we have the sort of reaction like we did to Coinbase late last week. Cat Tractor, tomorrow morning, guy, before the close. Anything interesting that you want to take away from that? We've obviously seen some big moves in Cat and Deer, and it was kind of the reflation trade and the like here. But is this one, when we think about some of the industrials that have not acted particularly well after the results, obviously a lot of them have had big moves. That one kind of sticks out to me where, I don't have any cares about like being involved in it, but what they have to say might be pretty interesting.
Yeah, and I think people are going to start to look at names like Caterpillar and some of these industrials as, they used to be sort of rusty America, slow and steady wins the race. And now a lot of these companies are trying to transform into this AI era. And you're going to hear on the back of this Caterpillar earnings report, I think, their implementation of AI and what, how that makes them a company that should be trading at a premium valuation. And to a certain extent, what you've seen in Caterpillar since April mirrors a lot of what you've seen in some of these tech names. I think the stock traded down to about 270 or so in early April. And then it's basically been on autopilot to the upside. And as we're sitting here, I don't think it's at an all-time high, but we're probably within $8 or $9 of one. So as crazy as it sounds, Cat can continue this move higher on the back of the excitement around their implementation of AI and the story around it.
Yeah, I mean, I'm kind of a seller of that as far as that as a narrative. I understand what you're saying is that's what the expectation is, but this is a company that's actually supposed to have year over year a decline in earnings about 15%, a decline in sales of about 3%, and is trading at 23 times, which you could say, well, that's a market multiple. You know what I mean? That sounds so bad. I mean, this is a stock that historically is traded at a discount to a market multiple because of the cyclicality and the like. So I find it, the stock's up 60-some% or so from those lows. You just made it sound like or you just kind of detailed the fact that it does look like a lot of tech stocks that have had these sorts of move 45%, 45-degree angle from the April lows to up where it is. It's kind of like on a runaway breakout. AMD, guy. Big run there after the close. A lot of excitement, I think, last week that the kind of the GPU trade was going to broaden out. I think we've kind of been talking about this for like 12 consecutive quarters, going back to, let's say, early 2023. How does this one shake out for you? 8% implied move in either direction. You could say, well, this stock trading at 44 times on 25% expected revenue growth, 19% expected next year, right? Earnings growth, let's call it 20% expected higher this year. This is not the value play in the space here, especially when you consider the fact that if they're going to take market share from NVIDIA, they're probably going to have to compete on price to some degree.
Yeah, I agree with that. Another stock that's doubled, like many, since the April lows. But what I think is going to happen here, people are going to look for what's the next sort of beta trade in the semis. And although the valuation is rich, as you've just outlined, I think people are going to start to look to AMD, which, by the way, I think is sort of behind the curve in terms of the AI trade. But, the market's looking past a lot of things. What I'll tell you, though, you go back and look the early spring of 2024, it's probably March, April. I think the stock made an all-time high of about 220-ish. What I think could happen here is we continue to sort of levitate into earnings and then exhaust ourselves and, make a bit of a double top. So I am watching this not only for the numbers, but the way the price action is on the back end.
All right, Disney, consumer discretionary. There's a whole host of other things going on there, right? They report on Wednesday before the opening, 5.5% implied move. Is this one that's very company specific, and as they think about their streaming service and the kind of shift that they made to profitability there, and then they obviously have the parks and they have the the whole host of other stuff, the networks and the studios and all that sort of stuff. This has always been a really difficult name for many reasons, because of these different parts of the business, because their geographic exposure and the like here, and obviously consumer discretionary to some degree. But we saw some difficult numbers out of Royal Caribbean, out of some of the airlines. Is it worth kind of extrapolating some of that to a Disney?
100%. I think you can do that. But then the flip side of that coin is you can say, well, wait a second, maybe the bloom a little bit is off the rose of Netflix, something that you've talked about, and maybe Disney wins to that. What I'll tell you is, everybody's darling Disney for years and years and years, and that obviously stopped and from 21 into early 22. Since then, 123-ish in terms of absolute price was where we stopped in August of 22. If you go back and look, where we stopped in the spring of 24, if you go back and look, and to a certain extent where we might have just topped out recently. But you get to close above 124, 125, and I think this puts it on a whole new trajectory, which, by the way, I think is going to happen. I think Disney could be one of these stealth plays on the long side into the back half of this year.
Here's another one, McDonald's. Wednesday after the close. So one of the areas that we've seen do okay in this environment, we just talked about it a little bit ago, were some staples we could call probably McDonald's a consumer staple. Are you worth calling it? Do you think that makes sense calling it a consumer staple here? This is one that interests me just because what they're going to have to say about a consumer, the trade down. This is something that we've talked about a lot over the last sort of year and a half. We've definitely seen some difficult numbers on some of their, let's say, competitors. You saw with Shake Shack, and again, that's a higher price point, but we also saw, Chipotle was not particularly a great quarter, and what they had to say about their price point and the consumer. Is McDonald's going to shed any light on that?
I think so. You might hear we've heard it before from McDonald's. I think it was about a year or so ago where the CFO talked about their customer being, I don't think he used the word constrained, but it was along those lines, and the stock acted in kind. And as much as this is, you'd label it a consumer staple, it's a pretty volatile one. And, you can go back all the way to 2022 when the stocks had some dramatic moves. I think it made an all-time high in late December of 21 of about 270. By early 22, it was trading down to about 215. We bounced. We saw another huge sell-off into, I want to say, late summer of that year. We've seen sell-offs in 2023 where the stock was $300. I think it went down to about 225, 230. Saw it again in 24. And to a certain extent, we've seen it this year. I mean, you just go back into the late fall of 24 into the spring of this year, when, again, the stock probably went from about 310 or so all the way down to probably about 275. So you're seeing significant percentage moves in this name. It's been pretty consistent, but we've just recently endured a sell-off. Now we're sort of on the other side. So I don't think it's unreasonable, given its history, to say this is the quarter that maybe we flirt with that 325, 326 level, which was the prior all-time high.
Yeah, and we kind of alluded to the fact a year ago the Fed was getting a bit more dovish because of their concerns about the labor market. And then when you just kind of flash forward and you see the revisions that we had over the last couple months and the print that we just put up, let's just take them at face value here. And again, I can see why people are frustrated with the fact that you put up these big months, you know what I mean, month over month, and then you kind of, with the kind of stroke of a pen, you kind of erase all of that. And then all of a sudden you're like, wait a minute, a quarter worth of jobs data is telling us something very different than, let's say, we were thinking about it from an economic standpoint, and then the way the markets were interpreting it, right? So now all of a sudden, if that is the concern, then you start thinking about, I get an article every day from a major publication guy that talks about AI taking jobs, okay? And maybe it's definitely a bit premature for that, but companies are speaking to that. Make no mistake about it. Amazon, Andy Jassy, the CEO of that company, remember he put out this internal memo a few weeks ago talking about that this is going to be something over the next few years that they start to lean into a little bit. So if you think about mass deportations, if you think about government job cuts, and you think about AI cuts, you think about cuts that are going to happen in the backlash, I guess, to a trade war, right, with higher input costs, maybe less demand, all of a sudden you get a sense for a very weakening sort of jobs market. If you come in and cut 25 basis points or even 50 basis points in September, the long and variable lags of that are not going to do a whole heck of a lot. And so that's why I'm just kind of focused on some of these names like a McDonald's. And then obviously as we get later into the month, we're going to hear from Walmart and Costco and some of the other big box retailers. And so you think some of them are built for this sort of environment. Other ones like a Best Buy are probably not, right? So if you're Walmart and you're selling a lot of groceries and you can kind of negotiate price and you're this monster, retailer, you're going to have a little bit more leeway. So again, that's why I kind of highlight the McDonald's guy. Anything else before we get out of here that sticks out to you this week? Anything about like today, we're basically up in the S&P, what we gave up on Friday. You can't keep a good market down, I guess.
No, I mean, you got some Fed speak this week. I think Wednesday you have 2 or 3 speeches. I think on Thursday, Bostic's going to speak. So I think for me, just to listen to the tone and given some of the rhetoric we've heard over the last couple of weeks surrounding the Fed, I think will be not necessarily market moving, but something to watch for sure. Eli Lilly on Thursday, I think before the bell is just to watch the price action there, a stock that's been under pressure recently off its all-time highs, just to sort of see how that plays out. And do we hear any more noise on Jerome Powell and President Trump's sort of fascination with his potential resignation or potential dismissal, neither of which I think are going to happen, but that's always out there as well. With all that said, again, to your point, as we're sitting here, we've recouped probably 70% of what we lost on Friday. And as you just said as well, that you can't keep a good market down.
You cannot. You can't keep a good podcast down either. Guy, you're sitting down with Peter Bookvar. You're going to do a quick macro rundown with Peter. That'll drop in the podcast store tomorrow afternoon. I talked to Brett Winton. He is the futurist over there at ARK Invest. That's Kathy Wood's company. We're going to talk a whole heck of a lot of AI and a lot of things going on with Tesla, robo-taxi and the like here. Maybe a little Optimus. Liz Young Thomas, guy, she's back, baby. This is going to be on Thursday on the Market Call and the Risk Reversal podcast. So really excited about that. So we got a lot going on here. We got earnings. We got data. We got anything that's going on in and around trade and tariffs and the like here. So stick around this week. We got a lot of stuff going on. Thanks for being here.